Thank you everyone for taking out time and joining this session on Saturday afternoon. I'll first start with the introduction of our speaker for the benefit of our audience. Ms. Shibani Sirkar is a senior executive vice president, head of equity research and fund manager at Kotak Mutual Fund. She has a total experience of 20 years in the Indian equity markets, of which more than 12 years have been with Kotak. Her primary responsibilities include equity fund management and heading the equity research team at Kotak. Prior to joining Kotak, she worked for almost 6 years with UTI Asset Management. She holds a PGDM in finance from TAPI Management Institute and a BSc honors in economics from St. Xavier's College, Calcutta. Currently, she is managing more than 5,000 crores under three funds: Kotak Focused Equity, Contra Fund, and Banking and Financial Services Fund. Thank you, Shibani ma'am, for joining in and addressing our audience and taking out time on Saturday.
Thank you so much. My pleasure to be here.
So I'll first start with a few questions,
Sure.
and then we will invite our audience to ask questions from you. I'll start with the obvious question that we have seen a broader market has given a phenomenal rally over the last 6 months. So people are concerned, how are the valuations placed across different key sectors like banking, IT, auto, FMCG? Also, what is your take on relative valuation on large, mid, and small caps?
So that's a very broad question, but let me just maybe take a little bit of time to explain our thought on the market as a whole. Then I'll take subsegments of large, mid, and small cap, and then we can answer some questions on sectors as well. So
Sure.
if you just take a step back and look at our markets, not just from the last few months, which have been phenomenal in terms of broader market participation, but you just take a step back and look at our market since 2020, since the COVID lows happened in March of 2020. Now, if you look at Indian markets, vis-a-vis global equity markets, India has actually been the best performing market from the COVID lows. And in fact, if you look at our mid and small cap indices, these indices have been the best performing indices the world over. So Indian markets have been on an up move, not just for the last 4 months, but actually since the last 3 years, since COVID happened in March 2020. Now, there have been three key factors which have led to the way our markets have outperformed relative to the global indices, where global equity markets have also done well. It's not that global markets have not done well, but relatively we have outperformed global markets and also our emerging market peers. Now, why that has happened is on the back of three key factors. Number one, our macro parameters have been far more resilient than most of the other economies of the world. So whether you look at it from a growth perspective, where relatively we continue to be among the fastest growing economies among the large nations, whether you look at it from interest rate inflation, notwithstanding 1 or 2 months of higher food inflation, but typically inflation has been more manageable and interest rates have also now been on pause for a while. So inflation, interest rate, fiscal deficit, despite COVID, was managed well. And now even current account deficit is largely under control. So that's been number one. That is the economy of the overall economy has been far more resilient. So that's the first E. I think the second most important factor for our markets, which has seen a huge transformation, is the fact that since COVID of March 2020 till 2023, corporate profitability has moved up and we've seen almost a 34% CAGR growth in corporate earnings for NSE 500 companies. Now, in the same period of time, if you look at nominal GDP growth has been in the range of 12, 13, 14%. And therefore, what this means is that in March 2020, our corporate profit to GDP ratio was 2.3%. That moved up to almost 4.3%. And this has been one of the biggest drivers for re-rating of our markets. And I think corporate profitability holds the key where markets are concerned. So that's the second E, which is earnings. So economy, earnings. The third factor has been flows and sentiment. Now, while FII flows have been patchy, what we have seen in the last 4 months is that FIIs who were net sellers of Indian equities for the first 3 months of this calendar year have turned positive, and they've turned positive in a big way. So we've seen now calendar year to date almost $15-16 billion of net FII flows, which means that the numbers have been very, very large over the last 3-4 months. So that's been one factor. The second is the domestic flows continue to be strong. And I think for our market, structurally, the change that has happened post March 2020 has been the revival and the strength of domestic flows, and that continues. And therefore, flows have had a large part to play, especially where the mid and small cap rally goes. So that's the construct of why our markets, really did well. Now the question comes is what now, and where are we on the valuation parameter? Now, while structurally we believe that next 2 years from an earnings trajectory, earnings should be fairly decent in the sense that we are building in about 15 to 18% earnings growth for FY24 and 25 for Nifty 50 companies. That means earnings trajectory is okay and fairly good. However, when you look at valuations, let's look at it in 3 parts. One is the Nifty, which is the large cap. So when you look at Nifty valuations are slightly above long-term averages. So Nifty is still, in terms of 1 year forward multiples, is still 1 standard deviation below long-term average, but it's above long-term averages, right? So it's not moved up significantly, but it is above fair value, right? When you look at mid and small cap valuations, on the other hand, the small cap valuations are considerably above long-term averages. So let me just give you some data points. So when you look at this Nifty small cap 250 PE on a 1 year forward basis, today we will be close to about 17.5, 18 times, while the average is at about 15.5 times. And similarly on the Nifty mid cap 150, we will be at about 25, 25.5 times 1 year forward, while the average is at about 23 times. So for the mid cap and the small cap indices, valuations are slightly more above long-term averages than what it is for the large cap indices. So valuations are clearly above fair value for large, mid and small, but more so for the mid and small caps, and more so for the small caps, given the kind of strength of the rally that we have seen. The other way to look at valuations is to look at India vis-a-vis the rest of the emerging market pack and look at India's premium to the MSCI EM. So India, as you know, typically trades at a premium to the MSCI emerging markets because our growth rates are higher. But today, the premium that we enjoy has again moved slightly above long-term averages. So on a relative basis also, we are starting to look expensive. We are not as expensive as what we were, say, 2 years ago when the premium had expanded to more than 80-100%. So we are above long-term averages. So net from a market construct, earnings remain strong, economy is strong, but our valuations are now above fair value in terms of range. So the way we are looking at markets is, if you have an overall asset allocation bucket, equity should move more neutral on the asset allocation side, use any upsides in the market to book some profits and come back to a neutral sort of a level on asset allocation. If a market corrects or if there is volatility, then use that volatility to build back equity. Between large cap, mid cap, and small cap, our belief is that at the margin, while, if you take a 4, 5, 6 year view, mid and small caps is definitely the place you have to be invested in. But in the near term, as I was mentioning, because the small cap or especially the micro cap segment is becoming more and more expensive on a relative basis, shift a little bit more towards large cap. So marginally overweight large caps and marginally underweight on mid and small caps. We are not saying that you sell out of mid and small caps completely, but what we are really saying is be mindful of valuations because the momentum is very, very strong. And whenever such momentum happens, you tend to make mistakes where picking stocks on mid and small caps. So now is the time to be careful. And before I stop and move to your next question, we believe that markets could see some degree of volatility because there are many events that are lined up from here to say about February, March, when the elections are. And now we don't know whether, when the election timing, etc. will be. But interest rates cycle and what the Fed decides, how the US economy in terms of their growth pans out, and how our interest rates behave will also be important. And now we have the new factor to consider, which is the monsoons. And hopefully there will be some catch up on monsoons in September. But overall, monsoons have been deficient. And therefore, rural demand is something that we will watch out for. And I'll give you an anecdotal, some interesting talks and takeaways that we had with some of our from the channel partners that we talked to, and distributors. What they have said is that the Independence Day weekend and the Onam festival actually in terms of demand was considerably better than what they had thought of. So the festive season, the monsoon impact, this could mean that there are a lot of data points to watch out for. So be prepared for some degree of volatility in the near term. So I've taken some time, but yeah, that's the way we look at markets.
Thank you so much, ma'am. That was very insightful. So the next question, the follow-up question comes as a fund house, how are you overweight and underweight on different key sectors? So what's your take as a fund house?
Yeah. So again, just going back to how earnings have panned out, what you would have seen in FY23 is that the domestic facing sectors contributed significantly to the earnings growth. So I think the biggest sector that contributed to earnings in FY23 was the BFSI, or the banking financial services sector. Now, when you look at FY24, the earnings growth becomes more broad-based, as in more and more sectors contribute to that 18-20% earnings that we are building in for FY24. So banks continue to grow, but the pace of growth comes off for banks. But domestic-facing sectors such as autos, auto ancillaries, cement, industrials, home building, capital goods continue to be the sectors which lead in terms of earnings trajectory. And therefore, from that perspective, these are the segments that we are positive on. So the entire industrials pack, which includes, say, manufacturing, capital goods, as well as infrastructure, including things like defense, etc., we are positive on. Here, while the growth trajectory is strong, and if you look at most of the companies that reported numbers in the last quarter showed fairly strong growth in order wins and the overall growth in their order book. But what we must be also cognizant of is this sector now, in terms of valuations, is not cheap, and valuations have moved up. And therefore, you have to be a little bit more selective. But structurally, this is a strong place to be in. Banking as a sector, we kind of like the overall space and the financial services sector. And structurally, again, this is a sector we are positive on. Also, this is a sector that has not participated in the rally as much as one would have anticipated. So if you look at specifically the large banks and the large private sector banks, the large public sector banks, these banks are now trading at multiples which look fairly attractive, while the return ratios in terms of return on equity has actually improved sharply over the last 3 years. So valuations here are in your favor where banks are concerned. Even on NBFC's insurance, valuations are in your favor. So they are not expensive. So that's why from a downside protection, this could be a sector to look at, while fundamentally also the sector has seen improvement in terms of, as I said, earnings and return ratios. The other sectors where we are positive on is auto and auto ancillary as a space. Cement, where we think that the overall impact on margins, positive impact on margins because of lower commodity costs is still to play out, and volume growth remains strong. And finally, the entire home building space, because your real estate demand has clearly picked up. But if you look at home building as a sector, has not participated as much. And the flow through of real estate demand will likely be seen where home building is concerned. So that's the other space where we are positive on. And I think if I can preempt a few questions as to where we are underweight. I think one sector where we are underweight, and this the global commodities, cyclical sectors, where it's very difficult to take a structural call and one has to be extremely quick and tactical about it. But at this point in time, given that global demand is weak, we are underweight on metals as a space. Now, the debate is on in where technology is concerned or IT is concerned. Now, this is a sector that today also we are underweight on our portfolios. And sorry, yeah. So we've been underweight on our portfolios for a while. So since I think beginning of 2023, we have been underweight on IT. But now is, again, you asked me this question in the beginning, is where do you have valuation comfort? And if you ask me, large cap IT is one segment where there is valuation comfort. So this is a segment that we are evaluating closely. Right now, we are underweight in our portfolios.
Sure. Thank you so much, ma'am. Just on the interest rate side, you have already covered it. but we saw some high inflation numbers for the last month. So what is your outlook on inflation and central bank policy?
So I think that the trajectory of inflation will be slightly higher than what we had anticipated, say at the beginning of this fiscal year. But inflation will stay below 6% for the year as a whole. So when you look at exit CPI inflation in March, we should be still below 6%. And as you know that RBI's band is 4% plus minus 2%. So it's on either side. So 6% is the upper end of the band. Now, when you look at inflation, even the next month reading will still be high because your food inflation continues to remain high. But what we have seen in the past instances when food inflation shot up, food inflation comes down also equally. And you would have anecdotally looked at prices of, some of the tomato prices or the onion prices, etc. All of that has started to cool off. So food inflation should start to moderate. Here, the only caveat will be the monsoons and the rabi sowing that ensues towards the winter months. So that's something that we will watch out for. But in a nutshell, today, if you ask me, CPI inflation should be closer to that 5.5%, maybe 5.5 to 6 would be the band. The important factor is if you look at the core CPI inflation, which is core CPI X of, which is CPI X of food and fuel, the core CPI numbers have started to moderate and has been largely stable. So it's not going up. That means there is no major demand-led inflation in the economy as such. So it's not overheating of the economy. Now, in this context, we believe that RBI should keep interest rates on hold. And remember, RBI, even when they did that incremental CRR hike, they said that they want to ensure that during the festive months, there will be adequate liquidity in the system. So RBI doesn't want to pull out liquidity to hurt demand at this point in time, which means that they will likely be accommodative and stay on hold. They may possibly not cut rates. Our view is that RBI will not cut rates till the Fed actually takes a stance or takes a step in terms of cutting rates. Now, in this context, when you look at the Fed fund futures, the Fed fund futures have now pushed out or delayed the first rate cut. And the Fed fund futures are telling you that the first rate cut will typically be either in April or May of next year, which is 2024. So interest rates where the Fed is concerned could stay higher for longer, which is why we believe that the RBI will be on pause for the time being. So we are not anticipating an interest rate cut in this calendar year as yet.
Right, understood, ma'am. Ma'am, you already addressed on the asset allocation part. Just wanted to ask that you're coming up with a multi-asset NFO next. It's already launched.
Yeah.
So if you can just throw us some light on the asset allocation that you are targeting over in this particular NFO.
Absolutely. So the NFO that we are launching is the multi-asset allocation fund. So we already have a multi-asset allocator fund of fund, which is a fund of fund structure, where the asset allocation is between debt, equity, and gold. And but that fund has a debt taxation. In this fund, we will have 4 key asset classes. So we are bringing power of 4. And this fund will also have equity taxation, which means it's a more tax efficient product as well. So if I can just take 2 minutes to explain what are the 4 asset classes and how we will move between the 4 asset classes. The 4 asset classes will be equity, debt, commodities, gold and silver, and overseas. Overseas will be through the ETF or the mutual fund route. Now, because we will ensure that we have equity taxation, equity allocation will be minimum of 65% and between 65 to 80. However, if the fund manager believes that the valuations are expensive and he wants to bring down equity below 65, he can bring it down to up to 20%. But the rest 45 will be met through arbitrage. So the net cash equity will come down, but you will keep 65% overall equity exposure, making up the rest through arbitrage. So the actual directional equity exposure will move between 20 and 80. And this fund will be a flexi cap. So there is no, no cap in terms of which segment to be in. So you can be large, mid, and small depending upon valuations. And it will be a diversified product of 50 to 60 stocks. The second is debt. Debt will be between 10 and 25. So minimum will be 10. And the way we will manage debt is GSECs as well as corporate bonds. GSECs will have medium-term maturity and you will move and be dynamic in terms of maturity. And on the corporate bond side, we will focus only on higher rated, good quality corporates. So we will not move down the rating curve for corporate bonds. The third aspect will be commodities. Again, minimum has to be 10, maximum 25, like in the case of debt. But commodity call will be more a macro call depending upon various macroeconomic parameters, and will be moving between gold and silver either through the ETF route or through the exchange traded commodity derivative route, where the underlying is the commodity that you're buying. The fourth part of the asset allocation will be the overseas exposure. We are keeping a provision in the fund which allows you to go up to 15% in overseas ETFs. So 0 to 15. But remember, there is a regulatory cap on overseas exposures for mutual funds. Today, the cap it's open, but it's a very small window that is open. So this will be more tactical. For instance, if we see that overseas markets, say, for example, the NASDAQ has fallen sharply, and there is a tactical valuation call that we can take, we will invest in the overseas bucket. But as I said, it will be more tactical in nature. So essentially, these are the 4 asset classes. The fund will seek to buy low, in the sense when valuations are low, you increase equity. When valuations are high, you decrease equity. We will use 3 key factors to decide between equity, debt, and commodities. So the first factor that we will look at is the price to earnings. So whenever markets are expensive on a PE basis, we will reduce equity and vice versa. For equity and debt, we will use earnings yield. So that means that whenever earnings yield is higher than bond yield, we will increase equity vis-a-vis debt. And whenever bond yield is higher than earnings yield, we will increase debt versus equity. So we will use the yield gap analysis to take a call of shifting between equity and debt. And finally, we will also look at momentum in the market, in the sense that when market momentum is strong, if your PE or your yield gap is saying that you should bring down equity, we will bring it down, but maybe not that much. So that's how it will work. So that's it in a nutshell. This is a product where we essentially are saying that you leave the asset allocation headache to the fund manager. And it's also a tax efficient product from because it's equity taxation.
Sure. Thank you so much, ma'am, for that. Now we will invite questions from our audience. Just a disclaimer that we cannot discuss any stock specific questions on this forum.
Yeah.
You may please raise hand, and then we'll invite the questions from audience.
Or maybe they can also put it in the chat box if that's spoken.
Yes, you can also put it in a chat option, and we'll just take it up. Just. Yeah. Please, sir,
Aditya, Manish
your
here.
question.
How are you?
Hi.
Thanks, Shibani. It was good insight. I would like to know about this new NFO of HDFC. What are the returns you're looking at, say, 18 to 24 months?
Of HDFC. Which one?
The new NFO, what you're launching. What's the returns you're looking at for a horizon of 18 to 24 months?
Sorry, I see, honestly speaking, we can't give return projections because returns depend upon the market. So I'll just give you, and I'll try to answer your question slightly differently, instead of giving you a number and saying this is what the return one should expect. Now, obviously, we have seen that if you look at data again over the last, say, 10-year period, between 2012 and 2022, every year, the asset class which emerges as a winner is different, right? So what we have seen is during the COVID period between 2020 and 21, gold was the asset class which really did well because there was a lot of uncertainty in the market. Similarly, then equities picks up. So in different years, different asset classes do well. Now, the idea of this fund or the NFO that we are launching is that through asset allocation on a risk-adjusted basis, you are able to deliver returns which are better on a risk-adjusted basis. So we already have an asset allocator fund of fund, which has been in existence since 2004. And that fund has been very dynamic in managing equity. So the equity portion has moved between 9% and 99%, and average equity has been about 69. And that fund since inception has actually generated alpha not only against its own benchmark, but it has generated alpha over the Nifty. So I can only tell you what has happened in the past. So that's been our experience in managing a multi-asset product. And we hope that the kind of fund that we are bringing to the table with more dynamic management, investing directly in stocks, we should be able to generate, or at least our endeavor will be to generate alpha over the benchmark. Now, the benchmark of the fund that we have will be a mix of equity, debt, gold, and silver. So 65% will be the equity benchmark, which is NSE 500 TRI. Another 25% will be the debt benchmark, 5% price of gold, 5% price of silver. And our endeavor will be to generate alpha over the benchmark.
That sounds good. So it looks like minimum 15%.
I will not be able to put a number, unfortunately, but
that's okay, Shibani. Now, if I ask you, I would
Yeah.
like to put say 25 to 50 lakhs in a staggered manner, where you would like that particular money to go actually, and just
so it depends
some
upon your
forecast.
risk appetite. So in this fund that we are launching, even if you want to put in lump sum, it's fine, because here the asset allocation is being done. So it's not that you have to do the asset allocations. If you're putting into a pure equity fund, we would say that put it in a staggered manner over the next 3 to 6 month period. However, if you're putting in the current asset allocation product that we are launching, there lump sum is also fine, because again, the asset allocation is being done through this product, and you're getting diversification and asset allocation. So it's okay to put in lump sum as well.
I'll leave it to Aditya then. Thank you very much.
Yeah, or you leave it to Aditya. Yeah, absolutely.
Thank you very much.
So this question is on behalf of our client and our esteemed investor, Mr. Rajesh Mehta.
Sure.
So his question is, what do you expect the market outlook to be if the government changes to the new India coalition?
Sure. I think this is a point that is there on everyone's mind, because clearly we are going into an election scenario, and markets will look to the election outcome in terms of the way the markets behave. So while I don't know what is going to be the outcome, however, today, if you look at on a base case basis, market is building in a scenario where the current government comes back in a similar sort of a majority, not a higher majority, but a similar sort of majority in the 2024 election. So that's what market is generally building in. Now, there can be two other scenarios. One is that the majority is lower and there is some sort of a coalition with the current set of political parties. In that case, market may see some volatility, but it will not be a huge correction, because ultimately, we believe that the overall policies of the government will continue. And the third probability or the third outcome can be a fact that the government itself changes and the other new India coalition comes in. If that is the case, then market will likely see far more volatility than what we are anticipating at the point. But if you look at as a base case scenario, so whenever we do valuations, we have a base case, bull case, and a bear case. Today, the base case scenario is that the government, and some political analysts have done some permutation combinations and looked at various outcomes. The base case scenario is that the current government comes back with the similar sort of majority that you have, which means that the market is also building in continuation from a policy perspective over the next 5-year period. So that's the base case that's there for the market.
Sure. Thank you, ma'am. Ma'am, the next question comes from our client, Mr. Prashant Desai. So his question is, from long-term perspective, say 5 to 7 years, does the valuation differential between large, mid, and small cap really matters when one is building a flexi cap or a multi-cap approach?
So yes, to some extent it matters, because see, finally, what when you're looking at large, mid, and small caps, while obviously for a next 5 to 7 year period, mid and small caps are very well placed, because we do believe that if you really have to play India growth story, certain sectors which are not representative in large caps are represented through mid and small caps, and therefore you have to have an exposure. The point is, how much volatility can you withstand in the near term? which can be over the next 1 or 2 years, and also what should be your allocation between mid, large, and small. So therefore, like in the case of this product that we are talking about, where you need to be dynamic in asset allocation, as a fund manager, you also need to be dynamic in terms of looking at large cap, mid cap, and small cap. I'll give you an example. If you look at, say, between the period of 2016 and 2017 till about 2018, mid and small caps had a stupendous rally. Then between 2018 and till almost 2020, for 3 years, mid and small caps.
Excuse me. You are in synergy. Which standard? 10th. Acha, 11
I'll ask everyone to be please on mute.
इनका भी indicator है.
Ma'am, you can now unmute yourself.
Yeah. So as I was saying that if you look at time periods, right, between 2019 or 2018 and 2020, for almost 2 years, only few large caps outperformed, right, in a big way. And therefore, if you have to create a portfolio, like in case of asset allocation, you also need to be dynamic in terms of moving between mid, large, and small. So while I take the point that from a 5-7 year perspective, having some mid cap allocation is obviously required, but you also need downside protection when markets fall sharply. And typically what we have seen is that when markets correct, then mid and small caps typically maybe correct more in that period of time. So therefore, you should look at risk-adjusted returns, have a mix of large cap, mid, and small. So one way of doing it is to have a large and mid kind of a strategy where you have mid and small cap exposure, but also have the stability of large cap. So that's asset allocation from a market cap perspective as well.
Right. Thank you, ma'am. The next question is from our client, Mr. Arvind Bhatnagar.
Yeah.
His question is, historical trends are available to us for existing MF schemes. What is the advantage of NFO to the investors?
Yeah, absolutely. So, any NFO that comes, you do have existing mutual funds. And in this case, like, in case of the multi-asset product, there are existing multi-asset funds in the market. So as a concept, this fund is not very different from the others, right? So what do you gain by coming into the NFO? There are only two key things. One is that this fund, from an asset allocation perspective, has a fourth asset allocation bucket, which is the overseas exposure, which is missing from some of the other existing funds. And that overseas exposure done tactically will give you some diversification on geography as well as in terms of currency. So that's number one. The second is every fund house has the same set of products in every category. So if you say mid cap or flexi cap or whichever category, you have different fund houses. Now, as an investor, you need to choose the fund house which brings to you on the table an investment process and philosophy which is well defined, well outlined, and well adhered to. And therefore, if you understand the investment philosophy of the fund house, so there could be some fund houses which have, say, a value bias. There could be some fund houses which are growth bias. As our philosophy has always been growth, but at a reasonable price, which means growth taking into account valuations. And also the process in terms of the kind of stocks that we pick, our churn ratios, how we look at businesses. Our focus has always been being long-term investors in the stocks and companies and investing in businesses and watching those businesses grow. So all I can say is that once you understand how different fund houses function, like it is in any other category, you choose which fund house you want to choose. Similarly, in this category as well. So these are the two differentiating factors. Otherwise, from a product perspective, to be very honest, there is nothing rocket science in the product.
After this call, we'll also come up with a one pager on this NFO for our clients.
Sure. Absolutely. That will help a lot. Yes.
Yes. Ma'am, the next question comes from our client, Mr. Naren Karnam. His question is, how do you look at the non-equity and non-debt asset classes, like InvITs, REITs, and particularly this is a multi-asset fund that you're launching. So how do you look at that non-equity and non-debt asset class?
So we do have the provision to invest in REIT and InvIT, but to be very honest, the kind of, and I'm not a debt fund manager and I'm not an expert on the REIT InvIT side, but the experience in managing REIT and InvIT has not been very great as such, and therefore we've kept it as an enabling provision in the fund, which allows the fund manager, if he believes again there's a great opportunity to take some exposure. But if you ask me, you should focus typically in terms of the asset allocation bucket, get your equity call right, and the rest will all just follow through. So I think that's the key to understand, that if your equity call is correct in terms of either taking up equity exposure or taking down equity exposure, all the other asset classes give you that additional kicker, but you have to get your equity call right. And I'll just to explain once again that 65% is equity, right? So that's given. Now 10% is debt, 10% is commodity. That leaves you with 15%. Now, depending on where you are, say on yield gap, etc., that other 15 can be split between debt, equity, and commodity. So that's how it will work. So the main thing is that 65, right? So yeah, that's how I will look at it.
Sure, ma'am. Thank you so much. The next question again comes from him. How do you look at these two product classes, active mutual funds and ETFs, particularly for generating alpha in mid and small cap space?
So ETF for mid and small cap, I don't think, I mean, you will not generate alpha, right? So
Right.
the basic concept of a passive fund, whichever category, the probability of you generating alpha in that category is 0, because the fund will typically track the benchmark, right? And you will see a tracking error. So you will never generate alpha. So the alpha will be generated only by an active fund. So that's the basis of active versus passive. Also, remember, when active funds generate alpha, remember they are generating alpha keeping in mind various constraints, right? So constraints could be things like an index can have more than 10% weight in a particular stock, but the active fund can't take that weight. So despite that, the funds are generating alpha. Second is active funds always have to keep some cash for liquidity purposes, for redemptions, etc. The index does not have any cash. And finally, our alpha is measured against TRI, right? And it's a total returns index. And despite that, when you look at our fund and across our categories, ability to generate alpha has been over time periods, 1 year, 3 year, 5 years since inception. So the fund manager is actually working doubly hard to generate that alpha over the benchmark. So if you ask me, in a passive fund, you will never generate alpha because that's what the fund is, right? I mean, it's a benchmark fund. And just to also one factor, since he asked specifically about mid and small caps, I think in mid and small caps, stock picking is even more important, right? The benchmark could have all sorts of stocks, but in a mid and small cap segment, the ability to understand businesses, ability to understand management quality, corporate governance, capital allocation, and valuations are even more important. And therefore, in a mid-cap and small-cap category, I would always suggest that look at an active portfolio vis-a-vis a passive portfolio.
Right. Thank you, ma'am. Mr. Rajesh Nangare has raised his hand. Sir, if you can unmute yourself if you have any question.
Sure.
Yeah, I had already. Can you hear me? This is Rajesh here.
Yes, sir. I can hear you.
Yeah. I had already written, but anyway, which agencies you prefer as, for example, for your research, apart from your research team that you have, like CRISIL or CARE? Generally, they also have good reports, and RBI comes up with excellent reports.
Yes.
But generally, the government agencies always want to put economy in a better light. Then how do you really take a call on, okay, I will refer to this particular agency or this report? And apart from that, once you refer to that particular agency's report and invest, do you track that error that has happened? Because there is an opportunity loss in terms of depending on certain reports. So how do you deal with that?
Sure. So to answer, and let me just again explain how our team and how we do research and how we take portfolio decisions. So we internally have a 16-member research team, which is looking at various sectors and various stocks. So a lot of our research is in-house research done by our own research analysts, where we take unbiased views on stocks, sectors, economy, etc. Today, we as a research house, we track about 460 odd stocks, which is about 89% of India's market capitalization. So that's our own internal coverage where we give views to our fund managers in terms of our recommendations on stocks. So a lot of the research is done in-house. So as a research team, we do rely or we do refer to on external research, which can be provided by various brokerages. So it can be, institutional equity houses, which are either FII houses or domestic. But and also we refer to data that RBI provides, for instance, or even CRISIL is providing, etc. However, the research that is done and the recommendation that is made on a particular stock is finally made by the analyst in the team, and it is a decision of that analyst. And of course, the analyst's own performance appraisal depends upon the outcome of his research. So if he has said buy a particular stock and the stock doesn't do well, his own performance appraisal will be impacted by that. So having a strong internal research team is very, very key in this business to remove the biases, as you mentioned, which can creep in certain factors. And therefore, you need to have a research team which is independent and which is very, very strong and very, very in terms of their overall experience. So the average experience of our research team, for instance, is in terms of work experience is about 12 to 15 years. So these are seasoned analysts who have been part of the industry for a long period of time. So that's how we work.
Thank you, ma'am. The next question is on the international funds. Some of our clients have been invested into some international funds as well, and which have not performed very well in the last three odd years. Absolutely. So, what's your outlook on the US market, considering the recent macro parameters that we are seeing over there? What's your outlook over there?
Yeah, so if you look at the S&P 500 in terms of returns, S&P 500 has delivered returns in the last 1 year. So in fact, if you look at the time from which the interest rate cycle started moving up, despite interest rate cycle moving up, S&P 500 has delivered returns. However, what you also saw is if you look at the recent past, in the US, the large caps have done better and mid and small caps have actually underperformed. So even NASDAQ has moved up, but even within NASDAQ, it is only a certain set of stocks which have really moved up. Unlike in India, where the rally has been very broad-based, right? So mid and small caps have outperformed. In the US, it's been the opposite, where the large caps and a few select tech stocks, etc., have done well and have pushed up the market. Now, the way I look at US, and I'm again, disclaimer, I am not an expert on the US markets, but the way I look at the US markets is that from a macro perspective, the expectation is that growth in the US would likely slow down. So you look at any parameter, most of the parameters are pointing to some sort of recession kicking in. So far, the US markets have not seen recession. Even the last GDP growth was positive and slightly ahead of estimates. But when you look at the yield curve being inverted, when you look at how the US household debt as well as government debt has moved up sharply, how interest rates have moved up sharply, it does point out to the fact that US macro parameters are not as strong as what one would have anticipated. The other factor is that if you look at today, US government interest payments are actually higher than their defense spend. Similarly, credit card interest rates have been moving up. Credit card debt has moved up. That means personal leverage has moved up and interest rates have gone up. That means on a consumer basis also there is stress because leverage has gone up. So I would say that US markets would possibly see some degree of volatility. If growth doesn't slow down and if growth remains resilient the way it has so far, then markets could outperform. But if the markets do move into a recession, then you could see markets being volatile. But that's a pretty layman's view on the US markets.
Sure. Thank you so much.
And so just so that's why, just to caveat it here, and I must also stress on this. So when I said in the multi-asset allocation fund, we do have provision for overseas investment through the ETF or the MF route. Remember, it's 0 to 15. So it will always be very tactical. It will be based on the fact that if markets in the US or say the NASDAQ, etc., correct very sharply, then tactically you will take some view and say that, okay, let's invest maybe 5-10%, but it will always be very, very tactical. It will not be a very structural, bet on the US markets. because we just want some sort of diversification on a tactical basis. And finally, from a regulatory perspective, the headroom for investing in overseas funds is very, very small. So we will not be able to, even if you want to take exposure.
Right. Thank you so much, ma'am. We'll just invite one more question.
Sure.
Anyone, I think we have taken care of all the questions in the chat. So if anyone has any question, you may please raise your hand. Yeah, there's one question. How do you look at the same? This again comes to the international allocation. How are you compare the Indian market Nifty 50 performance compared with S&P 500?
See, the way I would look at it is you should always invest most of your money in a market that you understand, right? So obviously, the most of the allocation in this fund will be on the domestic side. Like I said, it will be only very, very tactical in terms of looking at international markets. So very small portion of the asset allocation.
Right. There's another question that we have from Mr. Mayank, that valuation seems to be at premium right now. Should the investors wait for a correction or buy on dips before any further investment? What is should be the correct way?
Yeah, so that's why we think that the multi-asset allocation fund is a good product, even if you feel valuations are expensive, because there the fund manager will moderate equity and will have higher allocation to other asset classes if he feels the valuations are expensive. So as I said, today, the way we look at markets are above fair value, but they're not super expensive. So they are not like very, very expensive, trading 2 standard deviation above long-term averages. They are above long-term averages, which is why we should not be exiting the market, but we should book some profit and bring down equity asset allocation to neutral. So that's how we are looking at the market. And the multi-asset product does that entire asset allocation for you. Otherwise, you will, Aditya, you will have to help in terms of the asset allocation and move between debt and equity. Yeah, so that's about it.
Absolutely.
Yeah.
I think we have addressed all the questions, ma'am. Thank you so much for such an insightful session.
Thank you very much.
So exhaustive. And I believe that our clients have really gained from this session in terms of their market outlook and in terms of their conviction in the markets. Thank you so much, ma'am.
Thank you very much for having me. It was a pleasure and it was very interactive. So thank you very much. I enjoyed it.
Thank you. Thank you so much, everyone, for joining this session. Thank you. Thank you.
Thank you. Have a good day, everyone, and a great weekend. Bye.
Thank you. Thank you so much.